Hi class, welcome back to EdVantage. I'm Matt Fisher, your accounting professor. In today's video, we're going to go over transportation costs. This is really important for you to understand because transportation costs are different depending on who's paying for those costs. So let's take a look at this. I have on the board the seller's place of business, and here's the buyer. So they're selling inventory items to the buyer, and here's our shipment. It's being shipped right now, and it could be via sea, truck, plane, rail, doesn't matter. But it's being shipped right now to the buyer. Now the question is, who owns this inventory? They both can't own it at the same time. It depends on the manner that it's being shipped. First of all, we have something called FOB, which stands for free on board shipping point, or we have FOB destination. It's going to be shipped one way, FOB shipping point, or the other, FOB destination. If it's FOB shipping point, what that's telling us is that's when it's exchanging hands. So that means if it's FOB shipping point, then the buyer is going to own the inventory. The buyer will own the inventory. So basically what's happening then is the buyer pays the shipping during transit. Well, they're paying the shipping. The buyer owns it during transit. The buyer assumes the risk of the inventory, so they want to make sure that they properly insure it. Okay. Now the journal entry is a little bit different. The journal entry, let's say we're paying $1,000 for this shipping. Well, the shipping cost will be attached to the inventory itself. It will be included with the inventory. Whenever we're purchasing inventory, what goes into that inventory cost isn't just the price of the inventory, it's also any shipping costs, taxes, tariffs, any other costs that are incurred get attached or included with the inventory. So here's our shipping cost, and it's going to go into inventory. Now, let's take a look at what happens if this is FOB destination. If this is shipped FOB destination, then this stuff here is kind of the opposite. What's happening is the seller pays the shipping. The seller owns, and I'll put down here while in transit. Transit just means while it's being shipped. Okay, so it's in transit right here. So if it's FOB destination, the seller's paid the shipping, the seller owns it, and the seller assumes all risk. So they want to make sure that they have it properly insured. Now let's take a look at the journal entry for that $1,000 payment. If the seller is paying the shipping, then they're going to debit shipping expense, or you might call it freight expense. And we said that it was $1,000. And then if they paid it, it would be a credit to cash, okay? So notice the difference here. Over here, we debited inventory. Over here, we're debiting shipping expense. The reason being is because they're selling this inventory. They don't have the inventory on their books anymore. So they're not going to attach it to the inventory. They're going to just immediately expense that shipping expense for $1,000. Okay, so this isn't hard to understand. You just need to get this down, what FOB shipping point is, what FOB destination is. It really makes sense. Just spend some time really thinking about it, because I promise you on tests, students, even though they understand this, they can get confused. So just make sure you understand really well what one of these is, and then you should understand the other one because it's just the opposite. All right, class, I hope this has helped you. Be sure to watch it again just to cement this in your brain and you really understand it. In the next video, we're gonna go over selling inventory items and looking at seller's discount, returns, and allowances. In the previous video, we looked at the purchasing side, and now we're gonna look at the selling side, the seller side, and those journal entries. All right, class, we'll see you later. I hope this has helped. Good luck in accounting.